China's industrial overcapacity is putting growing pressure on economies worldwide, and the world may be nearing its breaking point. Could it, China, trigger a global economic crisis? That is one topic of Michael Froman's latest piece published yesterday by Foreign Affairs magazine. And Ambassador Michael Froman joins us now. He's the president of the Council on Foreign Relations and former U.S. trade representative as well. And Ambassador, Mr. Ambassador, I want to get to China in a second, but I do want to start with the news that we just sort of hit. We don't know a lot about it, so I'm going to ask you to speculate. Treasury Secretary Scott Bessent saying the U.S. is prepared or will put unprecedented economic pressure on Iran. 2-point question. Number one, do you believe this means we will reduce the kinetic war, the actual fighting around Iran, and any clues as to what this economic pressure might be?
Well, I think we're waiting for the details, but certainly there's been talk about strengthening the blockade again and restricting further the shipping out of oil and other products out of the Persian Gulf. There are more sanctions to be provided on Iran and potentially on buyers of Iranian oil as well. I don't think it necessarily means that the kinetic action is going to decrease. I think really the president is faced with three not terribly good options. One is to escalate both economically and militarily and take control effectively of the Strait of Hormuz. That comes at a great cost. One is to capitulate and basically go back to the MOU that was agreed to with Iran, where Iran insisted that the U.S. pull back from Iran, stop threatening it, pull back from attacking or supporting Israel's efforts vis-a-vis Hezbollah and release frozen assets. And the third is to continue on this kind of stalemate where we escalate and de-escalate by week, depending on where we are on the diplomatic and on the military side of things. So there aren't a lot of great choices right now, but certainly strengthening the economic sanctions and the military pressure is one track that the president may well go down.
Do you think that it would work? Michael, do you think that we'd be able to apply a specific amount of economic pressure that would effectively break Iranian will and any Iranian resistance?
I think normal sanctions, we've seen raft after raft of sanctions, and Iran has demonstrated a great capacity to absorb pain and continue on the path they've been on. I think the big question is, if you had a blockade, an effective blockade in place for an extended period of time, obviously we would have to live with higher oil prices, but Iran ultimately would have difficulty getting its oil out of the ground. It would have to shut in wells. And as you know, that's a very expensive and long-term damaging process, where it's hard to get your oil back going again once you've shut in your production. And we've not gone that far. We've not put the blockade in for that long to force that situation. So we don't know whether that would actually ultimately change Iran's trajectory. The Revolutionary Guard gets a lot of its revenue from the oil sector. And so if you effectively cut that off, the theory is you might create divisions within the government, or further divisions within the government between the Revolutionary Guard and others, and perhaps change their negotiating position.
Michael, I want to ask you about an article that you published yesterday in Foreign Affairs called "The Next Global Economic Crisis Could Be Made in China." What makes you concerned about an economic crisis there? What's some of the evidence?
So everybody's been concerned about Chinese overcapacity, and they're exporting that overcapacity to the rest of the world, the impact that's had on the rest of the world. But we're now reaching a stage where two things are going on. One, on the political side, more and more countries are saying we're going to go down the road of protectionism to keep Chinese excess capacity out of our market. The U.S. has, for example, effectively closed our market to electric vehicles from China. Europe, which is ideologically more committed to free trade than the U.S. historically, it is now beginning to pursue protectionist measures as well, as it sees itself losing jobs in the auto sector, closing down factories. And that has big political and social ramifications for Europe. And major emerging economies who want to have a manufacturing sector, whether it's Brazil or India or South Africa or others, Indonesia, they too want to resist the dumping of products from China that are undermining their capacity to pursue that. So that's one thing that's going on, is simply the rise of protectionism globally. And secondly, it's the law of arithmetic. It was one thing for China to export substantially more faster than the global growth of trade when it was was 10% of the global economy. But now it's 25% of the global economy. It's 30% of all manufacturing. It's heading towards 45% of all manufacturing. In certain sectors like EVs, it can produce, virtually 60% of global demand for the product, if not more. At that scale, the more it continues to export in excess of global demand, it's unsustainable. And so you could see it collapsing on itself, where markets close, there isn't sufficient demand, and all of these companies in China that are operating at narrow to negative margins begin to implode, and that's going to affect Chinese growth. And when Chinese growth is affected, it affects all those countries that are also dependent on China. China is the number one trading partner for so many emerging economies and developing countries. When they see a reduction in Chinese demand, they too will be affected, and they're all carrying a lot of debt. And so it has all the makings of a global financial crisis, where demand gets hit because of the Chinese economic strategy beginning to collapse on itself. And those who trade with China are beginning to see the effects as well. And the U.S. could well be left holding the bag.
Yeah, I mean, a headline in the Wall Street Journal this morning: there aren't enough ships to handle China's booming car exports. So that story is well known, but maybe getting to a more extreme point. Michael, you would think the Chinese authorities are broad terms aware of all this, and maybe it explains part of the urgency for them to invest so heavily in AI, in their own domestic AI capacity, their own kind of tech infrastructure, and maybe they feel as if that's an escape hatch.
They certainly know that this is an issue, and the U.S. and others have been pressing China literally for 2 decades to reform their economy, to move towards domestic demand-led growth, to put in place a real social safety net so that consumers don't save 50% of their income. So the problem is well known. The solutions are well known. I think the challenge is this is the playbook they go back to export excess manufacturing capacity, because it's worked so well for them in the past, and it just may be running out of room. And as you said, you got to find another sector. The property sector's grown and bubbled and now collapsed. It's hard to find another sector that can replace export-led growth in the same way in terms of driving Chinese growth. AI can do some, and certainly they are investing heavily in that and in biotech, but it's not the kind of sector that's going to necessarily employ so much of the Chinese population and account for 30% of their growth as exports are currently accounting for.